Hello and welcome back to another great segment of Richard Williams UPS, Richard Williams Asset Protectors. Thank you for stopping by my YouTube channel. Be sure to like and subscribe to my YouTube channel, and hopefully you see something you like here. I want to talk today about term life versus whole life. So how do you know which is the right insurance for you, right? We're talking about life insurance, life insurance. You have term life insurance. Term life insurance is typically about 10, 15, well 10 to 30 years. It could be 15 or 25 years as well. So 10, 15, 20, 25, 30 years. It's a term. That's all it is, a term. Think about when you were in school, that semester, this term, first semester, second semester, term, right? Or if you're carrying a baby, then from the time that the pregnancy happens to the time that the baby is delivered is the term, okay? So 10 to 30 years is pretty much the term. The main thing about it, I want to skip here, is that it is a death benefit is the main thing, is the first number one thing about life insurance, okay? Regardless of what it does, every one of them, number one, is the death benefit. And the death benefit is a gift that you leave to your loved ones once you pass away. Death benefit. So you got gift, that's the death benefit, okay? Accelerated death benefit, that just means that if you have a situation, let's say you become terminally or critically ill, in other words, is that you're gonna, you have a life expectancy of 12 months or less, or you can't do 2 out of 6 of the daily living activities. And some of the daily activities include things like being able to go to the toilet by yourself, being able to walk without someone helping you walk, being able to hold your urine and feces without having to wear Pampers, okay? Things like that. Those are some things that could cause that to initiate early and give you up to 75% in most cases of your death benefit. So how that works is if you needed to exercise that and use that 75%, let's just say you have a $100,000 policy. You have a $100,000 policy, right? And you need to use 75% of that, right? That's going to leave you what? 25%, right? In this case, it's going to leave you $25,000. This becomes your new death benefit. That's all that's saying. All right? Moving over now to the whole life, and it's called whole life for a reason, because it will insure a person for their whole life, okay? So if you live 100 years, whole life. Some of the policies up to 121 years. And whole life is a type of insurance that you can buy for children as well, what we call children's whole life. And in children's whole life, you can get that from the time they are, like 15 days, right? So 0 years up to whatever. So you can start at that time or whatever time. If you do it later in life, it's more expensive, but it costs a lot cheaper, of course, to start it early. As you get older with life insurance, whole life insurance, the price is going to go up with you because of the cost of insurance, other policies and fees and things that's built into the policy. Like I say, 100 years in this, it can build cash value. So let's just say if you want to buy $100,000 worth of insurance, you buy $100,000 worth of insurance, right? And you start, let's say you are 25 years old, and that $100,000 worth of life insurance, let's say it costs you $25 a month, for example, for that $100,000. But you pay $200 a month, right? It costs you let's say it costs you $25 a month, but you pay $200 in, right? By you overpaying that into that, it will cause it to go up. Now with a whole life insurance policy, that is a good policy you can do that with. But for me personally, I like the IUL to overpay that because it tends to perform better. You get less penalties, and you get a higher return on your cash value. Okay, because the cost of whole life insurance is going to go up with age, the cost of insurance. And any insurance is going to go up, but this is going to go up significantly more than the other ones. You have loan provisions, meaning that, let's say if you have $25,000 in that account and you need to borrow $5,000 for whatever reason to pay down some debt or pay off a bill or whatever the case might be, or maybe you want to purchase something, then you can take that from that whole life. The good part about whole life that I really like is that it's your whole life. Whereas with the term policy here, after 30 years, this policy is over. So you've been paying on this policy for 30 years, and then you still living, right? You live 5 years after this policy is over, this policy is not going to pay, okay? This policy is not going to pay. And when you do, let's say you are 50 years old when you get the policy. Let's say you're 40 years old and you get the policy. Now you're 70 years old, right? Right? So 40 plus 30 equals, now you're 70 years old. How much do you think this insurance is going to cost you as opposed to what it costs you at 40? How much is it going to cost you at 70 as opposed to what it's going to cost you at 40? That's where they get you at. This is why the whole life works better. But I liked it personally, the index universal life insurance policy, for a lot of reasons. One, tax benefits. Two, the cash value grows a lot faster. Number three, the liquidity. You're going to have more in your pool to draw from if you're in your time of need. You dealing with these numbers. You saying, okay, you need 25,000, right? But you don't have enough. Let's say you need 25,000, but you only got 75,000 in the bank or in your policy, not the bank, in your policy. Now what do? So to keep you from running into those cliffhangers like that, I recommend the Index Universal Life Insurance Policy, the IUL, Index Universal Life Insurance Policy. It does all this and a lot more. Whereas over here you have tax breaks, right? You have, of course, you have your loan provisions, which you already have here. You already have your cash value here, right? You have cash accumulation value, right? And also when you pay it back, you're paying back to yourself. You're not borrowing from the policy, you borrow from yourself here. And this is what we call the infinite banking system. And the infinite banking system is essentially you own your own bank. What if you pull up to Wells Fargo and you own it? You go to Chase Bank and you own it. You go in there and just stick your hand in and get what you want. Same is true here. So if you need to borrow money from yourself, borrow from here. At the same time, your money is also protected. It's protected from legal issues, from bills, right? Private litigation, civil suits, lawsuits, divorce, all those things. So put your money in your insurance because that's where it's going to count at, okay? So basically I'm giving you the breakdown between the difference between a term and a whole life, okay? I didn't go over death benefit here because I told you that in the beginning that every life insurance policy has a death benefit. And we could list more things to go with these. However, this is enough. This should be enough to pique your interest, enough for you to look into it. And if you desire, reach out to me. Go to UnitedProspera.com. It is right there in the link, UnitedProspera.com. And set up a time with me to talk or get with the person that you know and trust in your community. Well, there's someone down the street that you know or a reputable company, it doesn't matter. Get insured. Protect your family. That's what it's all about, okay? If you want me to do it, I'll be happy to help walk you through it. Happy to get you set up at no cost to you. I'll never invoice you for anything. The company compensates me very well. So pretty much that's my time. I thank you for yours. I look forward to sharing with you on your next video. Meanwhile, don't forget to subscribe, like, and share. And I'll see you on the next video. Meanwhile, take care of yourself and each other. See you soon. Peace.